So in this video, we're going to go over the difference between saving and investing, all right? You want to understand the options, okay, the different types of saving and investing, the risk associated with both saving and investing, the possible returns for each, and the liquidity differences between the two. If you don't know what liquidity is, we'll define that a little bit later, okay? So first off, savings, what is it? Everyone should start saving right away, okay? You never know when you might have an emergency come up. You never know when you might need to have some purchasing power, and savings is the way to make that happen. Investing will play a role there too. All right, saving is putting money away into a savings account. The oldest version of saving was, like a piggy bank. Savings bonds, certificates of deposit, and money market accounts. All right, savings is generally very low risk. All right, the return on most savings devices is very low, or in some cases non-existent, like with the piggy bank. Okay, investing, what is it? You should also start investing now, all right? And we'll talk later on about types of investments and a way to start very safely, but you need to start doing some research on investing and maybe start a basic investing account either through your work or through some applications that are out there right now. All right, investing is buying assets that you think will grow in value over time. Okay. Some examples: stocks and bonds, mutual funds are probably the most basic ones that it's easy for everybody to participate in. Buying real estate, buying works of art, buying precious stones or gems, and investing in businesses are some examples. There are many more. All right, investing is a lot higher risk than savings. And later on in class, we'll talk about ways to limit that risk, okay? And you need to understand your risk threshold, okay? Even though it's more risky, the potential for return is a lot greater, okay? So there's always going to be a balance between the risk and the return, okay? And you need to understand what your threshold is. Some people don't like taking risks. Some people are a little more willing to take risks in order to increase the potential return, okay? You need to know what your balance is and invest accordingly. All right, so risk, what is it? So risk is the potential to lose the money that you have saved or invested, okay? With savings, okay, generally you're going to put your money into an FDIC or NCUA insured bank or credit union, okay, and those are protected or insured up to $250,000. So your money is very safe in those accounts. If you're saving more than $250,000, I would suggest investing some of that money so you get the potential for greater growth. Okay? Other savings devices are very low risk as well. And with investments, when you invest in the stock market or when you invest in other assets, it's inherently more risky, okay? The potential is always there to lose the money you invested. You have to be aware of that going in, okay? Mutual funds are less risky than stocks because the investment is spread out over multiple companies. And just make sure you do the necessary research for anything you invest in. Okay. Return. Return is the amount of growth you get for your savings or for your investment. Okay. It's money that you get on top of what you put in to start. Okay. Savings accounts, CDs, money market funds all have low fixed interest rates. In some cases, you need to be aware the interest rate that you earn on those will not outpace inflation, okay? Which means your money actually loses buying power while it's in that savings account, okay? So inflation a lot of times outpaces those interest rates, so your money's actually worth less when you decide you want to use it. Okay. With stocks and mutual funds, they ebb and flow over time. Okay, the return is not fixed. In most cases, the return is not fixed, but you can earn higher rates of returns with stocks and mutual funds and those other investment opportunities we spoke about earlier. Okay, you're not guaranteed to make money. Okay, if you buy into the wrong companies, you can lose your investment. Okay, liquidity, what is that? All right, liquidity is the ability to have access to your money, okay? If you're considered very liquid, then you have quick access to your money. If you're not very liquid, then it's gonna take you time to access your money or your funds, okay? With savings accounts, they are generally very liquid, okay? You can make a withdrawal from your savings account, usually, on the day that you need it, okay? So that would be considered very liquid. Okay. Other types of savings devices like CDs may be locked into a certain amount of time, okay? A lot of CDs are like 6 months or 12-month CDs. So when you put that money in, you know it's there for 6 months. If you have to take it out, usually there's a penalty that is associated with that, okay? With investing, when you buy stocks or mutual funds, it will take a couple of days usually to access your money, okay? You're gonna sell those at whatever the current market price is, and once those sales clear, okay, then you're gonna be able to access your money. It usually takes a few days for that to happen, okay? Other investments like artwork or real estate, or if you've invested in businesses, sometimes it can take a long time to sell those, okay? Because you got to find a buyer who's willing to pay what you want for those. So that would be considered not very liquid because you wouldn't have access to your money right away, okay? So that's the difference between saving and investing and all the things that go along with those two.